Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis on the trade desk because the stock is up 20, almost 20% today. And the news of the day is that they have a deal, a partnership with OpenAI, and the CEO, Jeff Green, bought $148 million worth of the stock. So the OpenAI news is pretty much that they're integrating the trade desk to sell ads within ChatGPT, which is great. That can probably make them a lot of money. Then the other thing to think, the reason the stock is down so much, I mean, this stock over the past 18 months, like there's not many stocks that get beaten down this bad. This stock just a year and a half ago was $90 a share, and it just fell all the way down to $23. So I have a little bit of a position in this. I bought 90 shares at about $30 a share. So, luckily we had this huge jump today and it brought me back up now to my cost basis. But, last week, 2 weeks ago, I was down a lot. But luckily this big jump here brought me back up. And then I think that this stock still has room to go. I mean, we're gonna break everything down here. I mean, here's the PE ratio of the past 4 years. This stock used to trade at 400 times earnings, which was ridiculous. And since then, it's gradually come down. So it's come all the way down now to about that was 29 times earnings yesterday. So luckily, it's in a much healthier place now. These charts are also very important to look at. These are the past 5 years for the stock, the free cash flow yield, which we want that to be high. You could see it normally was around 1 to 2%, which is basically nothing. And then these past couple of weeks here, we've seen it get as high as almost 7%, and now it's at about 5.5%, which is still good. Still much higher than where it's been the last 5 years. So, which makes it look like an attractive investment right now. Price to sales, same thing. Used to trade way higher. Now, I mean, 35 times price to sales is kind of ridiculous. That's ridiculous for almost any company. But I mean, and then it traded at around, in the 20s for multiple years too, which is still high. So luckily, right now we're back down to about 4 or 5 times earnings. Much healthier, makes much more sense. And then we look at price to earnings these last couple years. Again, it's come down a lot, 600 a couple years ago to now a 32. It's around a 32. So then, of course, the valuation is down a lot, but you got to ask why. Is it because the company is, you know, being disrupted? Are they going out of business? Or is it just investors are scared? And, the big thing has been these other companies like Amazon and Google, which the thing with them is Amazon sells ads, but they have Amazon Prime, and Google has YouTube, which it talks about here. Unlike Google or Amazon, Trade Desk does not own any content like YouTube and Prime Video. So that independence is their greatest strength because they don't have to sell, they're not selling their own inventory. So advertisers can trust them more to find the best deal across the whole internet. And now that they're working with ChatGPT, that's another huge positive. I'm not saying the whole business should rely on that, but they work with a lot of different organizations and companies. So if you buy ads on Google, Google is the pitcher, the catcher, and the umpire. TDD is just the coach helping you win, which is a good analogy, I guess. They created Unified ID 2.0, which has become the industry standard for tracking users without using cookies, which is another good thing a lot of companies look for. By getting major players like Disney and potentially OpenAI to adopt it, they made a network effect where everyone has to use their tech to target ads. So there's a lot going for the company. I mean, I could see now. See, this says Amazon's new demand side platform is faster and cheaper. Amazon has purchase data, blah blah blah. That is definitely a competitive advantage, and that's great for Amazon. But I don't see that being where Trade Desk is just destined for failure and the company is going to go under. I don't see that. I think it's been too extreme of a change these last couple of years where the stock was at 500 times earnings and now it was pretty much priced like it's irrelevant. Critics argue the 20% take rate, the fee that Trade Desk is taking, is too high and will eventually be forced down by competition. That's a possibility. It is. Because if these other things like Amazon are faster and cheaper, maybe that does drive the price down. But again, like we just noted, there's also that bias that Amazon and Google are going to have because they're going to try to, you know, place more of the money, the advertising budget on their own content, like Prime or YouTube or whatever. And that's why some companies might want to go with Trade Desk to have that neutrality there. So that's another bullish thing for the Trade Desk. And I see it being a likely scenario that Amazon, Google, and Trade Desk all have a significant portion of market share. Why can't they all have 30 to 40% market share? There's no reason that can't happen. Now, sure, it could drive down pricing, and that's going to hurt the Trade Desk a lot more than it's going to hurt a company like Google or Amazon. So Trade Desk is definitely subject to that more. There could be more volatility with that. But the way this stock got beaten down, I think, is way too extreme. And I think right now this stock deserves to be probably around $35. And then going into next year, I think it should be over $40 a share. So that's kind of the way I see it. We could look at again, you want to look at the growth here. Like I said, the valuations are going down, but we got to look at growth because the company is not growing the way it was. The 5-year average growth rate for this company was 28%. Last year they did 18%. Now they're guiding for only 13% revenue growth. Same thing. Let's look at net income. Net income, luckily, has been. It's almost weird to gauge this, but it's the 5 year is the same as the 1 year. So that one's not a huge change. Then we go to free cash flow, 5-year average of 20%, 1 year is 24%. So in that case, it actually looks better. So that's kind of the way I'm looking at this, is that there's definitely room for this to go up. I almost want to buy more, but I'm not going to buy more at this price because it's up 20% today. But luckily, I have a small position built out in this already, and we will see what happens. So that is all for today. Thank you, and I will see you in the next video.